There I was, watching another retiree's portfolio collapse. A man who thought his dividend checks meant he was winning. He called me confused, angry. His monthly income had vanished overnight. 3 stocks, all slashed their dividends within 18 months of each other. But Ray, he said, they were paying me every quarter, like clockwork. How does something paying you money bankrupt you? I've been studying markets for over 50 years. I've seen bubbles inflate and explode. I've watched currencies collapse. I've navigated crashes that erased trillions. But here's what most people don't know. I've watched more fortunes destroyed by safe dividend stocks than by any market crash. And the victims never see it coming. Because dividends feel like proof. Monthly checks hitting your account. That's tangible. That's real money. That must mean the company is healthy, right? Wrong. Dividends are financial morphine. They numb the pain while the disease spreads underneath. Let me explain something I learned the hard way. Cash flow and value creation are not the same thing, not even close. A company can pay you dividends while simultaneously destroying itself, while gutting its future, while writing checks it has no business writing. And investors, smart investors, mistake those checks for strength. I've seen it 1,000 times. Someone retires with a portfolio of 7% yielders. They think they cracked the code. They're collecting income while everyone else gambles on growth stocks. They feel superior, wise, conservative. Then the cuts come, and suddenly that safe income stream was a trapdoor the whole time. Here's the thing about high-yield dividend stocks. They're almost always high-yield for a reason. The market isn't stupid. When a stock yields 8% and the market average is 2%, that's not a gift. That's a warning. The market is pricing in disaster. It's saying, this dividend won't last. But investors see that 8% and their brains shut off. They think they found buried treasure. They don't ask why it's there in the first place. Let me show you something that'll change how you see dividends forever. Imagine 2 investors. Both start with $100,000. Investor A chases yield. Finds stocks paying 8%. Collects $8,000 a year. Feels like a genius. Investor B is boring. Buys quality companies paying 2%. Only collects $2,000 a year. Feels like he's missing out. 20 years later, Investor A has nothing. His high yielders cut dividends. Stock prices collapsed. His $100,000 is now worth $40,000. His income is $1,200 a year. Investor B, his boring 2% yielders grew their dividends every single year. His income is now $8,500 annually. His portfolio is worth $380,000. Same starting point. Opposite outcomes. Because Investor A was collecting cash while his companies died. Investor B owned companies that grew. This is the illusion that destroys wealth, confusing income with investing. A dividend is not a return on your investment. It's a return of your investment, your own money, filtered through a corporate account and handed back to you. Unless that company is growing, innovating, competing, thriving. Then and only then is a dividend actually adding value. Most high-yield dividends are just asset liquidations in disguise. The company is selling its future to pay you today. And here's the cruelest part. Management teams know this. They know the dividend isn't sustainable. But they also know that cutting it will crash the stock price. So they keep paying and paying and paying until they can't. And by then, you've been collecting checks while your principal evaporated. I learned this during the 2008 crisis. I watched companies with 50-year dividend histories cut to zero. Safe blue chips that investors had held for decades, gone. The survivors? They were the companies that slashed dividends early. They chose survival over shareholder appeasement. The ones that tried to maintain dividends? Most of them don't exist anymore. Here's what nobody tells you about dividend investing. High dividends often signal desperation, not strength. A healthy company pays a modest dividend and reinvests the rest. It's building, expanding, preparing for the future. A desperate company pays a massive dividend because it has nothing else to offer. No growth, no innovation, just cash distributions to keep shareholders from fleeing. It's the financial equivalent of a failing restaurant offering free desserts. Looks generous, actually a death rattle. So how do you spot the difference between a dividend that feeds you and one that's feeding off you? How do you know if that dividend check is real wealth or a ticking time bomb? Sign number 1, the payout ratio trap. Most investors have never even heard of this term, but it's the difference between building wealth and watching it evaporate. Here's what payout ratio means in plain English. What percentage of a company's earnings goes straight out the door as dividends? If a company earns $1 per share and pays out 0.50 cents in dividends, that's a 50% payout ratio. Healthy. Sustainable. Room to breathe. But when a company earns $1 and pays out 0.90 cents, or $0.90, or sometimes even more than it earns, that's a company writing checks its business can't cash. I'll tell you exactly what this looks like in the real world. I watched a telecommunications giant maintain its dividend for years. Investors loved it. 8% yield. Paid like clockwork. But the payout ratio, over 90%. Every quarter, management was scraping together every dollar of profit and handing it to shareholders. Nothing left over. Nothing for innovation. Nothing for infrastructure. Nothing for competing with the new players entering the market. And investors? They just kept collecting those checks. Never asked questions. Never looked under the hood. Until the company couldn't compete anymore, revenue started falling. The dividend became mathematically impossible. Cut by 60% overnight. Stock price? Down 70% within a year. Here's what I need you to understand. When a company pays out 90% or more of its earnings as dividends, it's not being generous. It's cannibalizing itself to keep you happy. Think about it like your personal finances. Imagine you make $5,000 a month, and every month you spend $4,500 on lifestyle, restaurants, cars, entertainment, whatever. You've got $500 left for emergencies, for savings, for your future. What happens when the car breaks down? When you lose your job? When anything unexpected occurs? You're finished. That's exactly what high payout ratio companies are doing. They're spending everything to maintain appearances while their foundation crumbles. But here's where it gets even more sinister. Management teams use dividends as distractions, as manipulation. I've sat in boardrooms. I've seen the calculations. When a company is struggling, when growth is stalled, when the competition is winning, what's the easiest way to keep shareholders from panicking? Maintain the dividend, or even raise it. It buys time. It creates the illusion of strength. It keeps the stock price from collapsing, at least for a while. Shareholders see that dividend increase and think, see? Everything's fine. They're doing great. Meanwhile, the core business is rotting. Market share is shrinking. Debt is piling up. But nobody notices, because those quarterly checks keep arriving. This is psychological warfare dressed as shareholder returns, and it works every single time. I learned this principle decades ago. Follow the cash, not the promises. A dividend is a promise. Earnings are cash. When promises exceed cash, something has to break. Let me give you the math that changed how I evaluate every dividend stock. Sustainable payout ratio? Under 60%. Preferably under 50%. That means the company pays out half its earnings and keeps half for growth, debt reduction, emergencies, and opportunities. Companies with payout ratios between 60 to 75%, yellow flag. Possible trouble ahead. Maybe they're mature and stable. Maybe they're masking decline. You need to investigate. Companies above 80%, red flag. Massive red flag. That dividend is living on borrowed time. Companies above 100%, paying out more than they earn? Run. Don't walk. Run. Because they're funding your dividend with debt or asset sales. or accounting tricks. You're not collecting income. You're collecting the dismantled pieces of a dying company. But here's the question that haunts me. What if the payout ratio looks fine and the company is still dying? What if management has structured the numbers to hide what's really happening? Because there's a second sign, a deeper sign, one that even sophisticated investors miss. What if the payout ratio looks healthy, but the company is funding those dividends with destruction? Sign number 2, the debt spiral. This is where companies get clever, where they hide the rot behind financial engineering. A company paying fat dividends while drowning in debt is choosing to pay you instead of saving itself. It's financial suicide dressed as generosity, and most investors never even check the debt levels. They see the dividend. They see the payout ratio looks reasonable. They buy in. Then they watch their investment disintegrate. Here's the reality. Debt isn't inherently bad. Smart companies use debt to grow, to expand, to invest in projects that generate returns higher than the interest rate. That's leverage. That's intelligent capital allocation. But when a company is taking on more debt every year while simultaneously paying massive dividends, that's not leverage. That's a Ponzi scheme. Let me paint you a picture. Imagine a man at a bar. Champagne for everyone. Big tips. Buying rounds. Looks successful. Looks generous. But every drink? Charged to a credit card that's already maxed out. He's not celebrating success. He's buying the appearance of success with borrowed money. That's exactly what these dividend traps do. I watched a retail chain do this for years. Debt climbing from $2 billion to $8 billion. But the dividend never missed a payment. Actually increased it twice. Investors thought, look how strong they are, growing the dividend while expanding. I thought, they're borrowing money to pay shareholders while their stores are losing to Amazon. Guess who was right? Dividend cut to zero. Stock down 90%. Bankruptcy. Here's how you spot this debt spiral before it kills your portfolio. Look at debt to equity ratio. This tells you how much debt the company has compared to shareholder equity. Under 0.5, generally healthy. They're not over-leveraged. Between 0.5 and 1.0, depends on the industry. Some industries naturally carry more debt, but you need to watch closely. Above 1.5, danger zone. Above 2.0, that company has more debt than equity. The creditors own more of the company than the shareholders do. And if that debt keeps rising every year while dividends keep flowing, you're holding a time bomb. But here's the metric that really tells the story. Interest coverage ratio. This shows whether the company can actually afford its debt. It's simple. Earnings before interest and taxes divided by interest expenses. If a company earns $100 million before interest and pays $10 million in interest, that's a coverage ratio of 10x comfortable, safe. But when that ratio drops below 3x, they're struggling to service the debt. Below 2x, they're one bad quarter away from trouble. Below 1x, they're not even earning enough to pay the interest, let alone the principal. And yet, I've seen companies with interest coverage below 2 buys still paying dividends. It's insanity. They're paying you while they can't even afford their own debt payments. Free cash flow tells you the real story. This is the cash left over after all expenses and investments. It's what's actually available. When free cash flow is positive and growing, the dividend has room to breathe. When free cash flow is negative or shrinking, that dividend is funded by something else, usually debt. I learned this the hard way during the 2008 financial crisis. I watched companies with safe dividends collapse because they had hidden their debt problems behind steady payouts. The companies that survive, they slashed dividends immediately, preserved cash, paid down debt. Their stock prices tanked in the short term. Investors panicked, sold, fled to the high yielders that kept paying. But 5 years later, the companies that cut dividends had recovered, thrived. Their stock prices hit new highs. The companies that tried to maintain dividends through the crisis, most of them don't exist anymore. Here's the cruel irony that keeps this cycle alive. The market punishes dividend cuts. When a company reduces or eliminates its dividend, the stock price crashes. Sometimes 20%, 30% in a single day. So management is terrified to cut. Because their stock-based compensation evaporates. Because activist investors attack. Because their job security vanishes. So they keep paying, keep borrowing, keep pretending, until the debt becomes unsustainable, until the creditors come calling, until bankruptcy is the only option left. And shareholders, the ones who thought they were being rewarded, lose everything. This is the addiction I've seen destroy more wealth than any other. Investors become psychologically dependent on dividend income. They need those quarterly checks. They built their retirement around them. They can't imagine cutting their income by 50% or 70%. So even when every metric screams danger, they hold on. They rationalize. They convince themselves management knows what they're doing. They're like gamblers at a slot machine that hasn't paid out in hours. Just one more spin. Just one more quarter. It has to hit eventually. But it doesn't. Here's what keeps me up at night. Payout ratios can be manipulated. Debt levels can be structured to look better than they are. But there's one sign that can't be hidden. One metric that reveals the truth, no matter how clever the accounting. It's the sign that terrifies me most. Because even smart investors miss it. The sign that terrifies me most is the one hidden in plain sight. Sign number 3. The shrinking revenue mirage. This is the most insidious trap because everything else can look fine. The dividend checks keep arriving. The payout ratio seems reasonable. Even the debt levels might look manageable. But the company is dying anyway. Because revenue is disappearing. Let me explain something fundamental. Revenue is lifeblood. It's the top line. It's what comes in before anything else matters. When revenue shrinks, year after year, no dividend is safe, no matter how stable it looks today. A company with declining revenue is a tree producing fruit while its roots rot. Eventually, there's nothing left to sustain it, and the fruit stops growing. I've watched this pattern destroy investors over and over. They focus on the dividend yield. They check the payout ratio. Maybe they even glance at debt. But they never ask, is this company actually growing or is it slowly dying? Here's how this plays out in the real world. I tracked an energy company for years. Massive dividend, 9% yield, payout ratio around 65%. Not terrible. Debt levels stable. Investors piled in. Safe income, they said. Blue chip stability. But I looked at the revenue trend. Down 3% one year. Down 5% the next. Down 7% the year after that. The company was shrinking. Customers were leaving. Competition was winning. Technology was changing. But the dividend kept coming. How? Cost cutting. They fired people. Closed facilities. Sold assets. Cut R&D to zero. Stopped investing in the future entirely. Every dollar they saved went straight to dividends. To keep shareholders happy. To maintain the illusion of strength. For 3 years, it worked. Then there was nothing left to cut. Revenue kept falling. The math became impossible. Dividends slashed 75%. Stock price collapsed 80%. Investors who thought they were collecting safe income watched their principal evaporate. Here's the truth. Nobody wants to hear. You cannot cut your way to prosperity. Cost reduction can buy time. It can stabilize a business temporarily, but it cannot replace revenue growth. A company maintaining dividends through cost cuts alone is liquidating its future to pay you today. It's not income. It's a controlled demolition that you're funding with your own capital. Look at any company's revenue over 3 to 5 years. Not 1 year, that can be a fluke. Not quarter to quarter, that's just noise. Multi-year trends. If revenue is growing consistently, even modestly, that company has a future. The dividend has a foundation. If revenue is flat for years, yellow flag. The company isn't dying, but it isn't thriving either. That dividend has no room for error. If revenue is declining year after year, red flag, massive red flag. That dividend is living on borrowed time no matter what else looks good. I've seen companies maintain dividends for 5, 6, even 7 years, while revenue declined every single year, and investors held on. Because the checks kept coming. Because they needed the income. Because they couldn't believe a company paying dividends could be in trouble. Then the cut came, and it was brutal. Here's what makes this so dangerous. Management will lie to you about it. Not explicitly, but through misdirection. They'll talk about strategic restructuring, about focusing on core markets, about improving margins. All code for we're shrinking and trying to make it sound like a plan. They'll trumpet earnings growth while revenue falls. How? Cost cuts, buybacks reducing share count, accounting adjustments. But earnings growth without revenue growth is an illusion. It's financial engineering. It cannot last. I learned this from watching the Japanese companies in the 1990s. After their bubble burst, dozens of major corporations kept paying dividends while their revenues fell for a decade. They maintained the appearance of stability. Shareholders collected income. But the companies were hollowing out, losing market share, becoming irrelevant. By the time the dividends finally stopped, the stock prices had fallen 60%, 70%, 80%. Some companies just disappeared entirely. The psychology here is brutal. Why do management teams do this? Short-term stock price. Executive bonuses tied to shareholder satisfaction. Legacy. Pride. Fear of admitting failure. And investors enable it. Because we're desperate for income. Unwilling to accept lower yields, terrified of change. So we believe the story. We ignore the declining revenue. We focus on the dividend until reality forces everyone to face the truth. Free cash flow, remember, tells you what's really available. But if that free cash flow is coming from a shrinking revenue base, you're not collecting income from a thriving business. You're collecting the liquidation proceeds of a dying one. I've seen this in retail, in telecom, in energy, in publishing, in any industry disrupted by technology or changing consumer behavior. The companies that adapt, they cut dividends early, invest in transformation, accept short-term pain for long-term survival. Their stocks get punished. If it ends, investors flee, but 5 years later, they're stronger than ever. The companies that cling to dividends, they die slowly, then quickly. Here's the framework I use. I want to see revenue growth of at least 3 to 5% annually over a 3-year period. Not every single year. Businesses have cycles. But the trend should be up. If revenue is flat or declining, I don't care how attractive the dividend looks. I don't care how safe it appears. I don't touch it. Because I've learned, when revenue dies, everything else follows. The dividend is always the last domino to fall. And by the time it falls, your principal has already been destroyed. So what do you do when you spot these signs? When you realize your safe dividend stock is actually a time bomb? Because here's what I learned the hard way. The moment you know something is wrong, you have a choice. You can act, or you can hope. Hope is expensive. I've made this mistake. Early in my career, I held a position too long. I saw the signs. Payout ratio creeping up. Debt rising. Revenue flat for 3 straight years. But the dividend kept coming, and I convinced myself, maybe they'll turn it around. Maybe I'm wrong. Maybe one more quarter. I wasn't wrong. The dividend got cut. The stock fell 60%. I lost tens of thousands of dollars that I didn't need to lose. Because I chose hope over evidence. Here's my philosophy now. Built from decades of mistakes and lessons, I'd rather own a company paying a 2% dividend that grows every year than an 8% dividend that's cannibalizing itself. Compounding beats yield. Every single time. Think about it. A 2% yield that grows 10% annually becomes 5.2% on your original investment in just 10 years, and the stock price typically follows. An 8% yield that gets cut in half, you're collecting 4%, and your principal is destroyed. It's the tortoise versus the hare. Except the hare is also on fire. Here's what I do now when I evaluate any dividend stock. First, payout ratio. I want it under 60%, preferably under 50%. If it's above 75%, I don't even continue the analysis, not interested. Second, debt levels. I look at debt to equity ratio. I look at interest coverage. I want to see the company can comfortably service its debt and pay the dividend with room to spare. If debt is rising while dividends are being paid, that's disqualifying. I don't care how good everything else looks. Third, revenue trend. I look at 3 to 5 years. I want to see growth. Consistent, sustainable growth. Not necessarily explosive, just steady and real. If revenue is shrinking, I'm out. Doesn't matter what the dividend is. A company with declining revenue is a melting ice cube. I'm not going to hold it and hope it refreezes. These 3 signs, high payout ratio, dangerous debt levels, shrinking revenue, are the trifecta of dividend disaster. One of them, you might survive if management fixes it quickly. 2 of them, you're in serious danger. All 3, you're not holding an investment. You're holding a ticking time bomb that hasn't exploded yet. But here's the insight that changed everything for me. Dividend should be a byproduct of success, not a substitute for it. A great company pays dividends because it's thriving, because it's generating more cash than it can productively reinvest, because rewarding shareholders is natural and easy. A desperate company pays dividends to convince you it's thriving, to distract you from the problems, to buy time before the inevitable. The difference is everything. I've watched boring companies, industrial manufacturers, consumer staples, utilities, pay modest 2 to 3% dividends for decades. Never looked sexy, never promised anything exciting, but over 20 years, those dividends doubled, then tripled. The stock prices followed. The investors who bought them 30 years ago are now collecting 15% yields on their original investment, and their principal has grown 500%, 800%, sometimes 1,000%. Meanwhile, the high yielders that look so attractive, most of them are gone. Cut dividends, filed bankruptcy, merged into obscurity. The sexy dividend that promised 8% delivered nothing. The boring dividend that started at 2% delivered generational wealth. This is what Wall Street doesn't want you to understand. Sustainable beats spectacular. Every time. So here's what you do right now, today. Look at your portfolio, every dividend stock you own. Check the payout ratio. If it's above 75%, you need a plan. Maybe you sell. Maybe you reduce your position. Maybe you watch it closely with a predetermined exit point. But you don't ignore it. Check the debt. Is it rising or falling? Can the company service it comfortably? If debt is climbing while dividends are being paid, you're in danger. Check revenue. Pull up the last 5 years. Is it growing? Flat? Shrinking? If it's shrinking, ask yourself, why am I holding this? What's my thesis? Am I investing based on evidence or hope? Because hope is not a strategy. I think about that retiree who called me, the one whose portfolio collapsed, the one who thought dividend checks meant safety. He held 3 stocks, all of them yielding above 7%. All of them looked safe based on past performance. None of them passed the 3 tests I just gave you. Payout ratios above 85%. Debt levels rising every year. Revenue declining for 3 straight years. The signs were there, visible to anyone who looked. But he didn't look. He just collected the checks and convinced himself that income equals security. Within 18 months, all 3 companies cut their dividends, 2 of them by more than 60%. One went to zero. His monthly income dropped from $4,200 to $900. His principal, His life savings fell from $720,000 to $310,000. He was 73 years old. He couldn't recover. He couldn't go back to work. He couldn't undo the damage. He thought he was being conservative, thought dividend stocks were the safe choice for retirees. He was collecting income while his wealth evaporated. That's the lesson, the hard truth, the thing nobody wants to hear. A dividend check is not proof of anything except that the company wrote you a check. It doesn't mean they're healthy, doesn't mean they're growing, doesn't mean your investment is safe. It just means they paid you. This quarter, this month. What matters is whether they can keep paying you, whether they should keep paying you, whether that payment is coming from strength or desperation. The 3 signs tell you everything: payout ratio, debt levels, revenue trends. Learn them, use them, trust them, because the market will lie to you. Management will lie to you. Even the dividend itself will lie to you. But the numbers don't lie. And when you see all 3 signs in the same company, you're not looking at a dividend stock. You're looking at a financial time bomb. The only question is whether you'll still be holding it when it explodes.